in properties. But the reason why we don't want to talk too much about property is because of the T word. T. Anyone wants to tell me? Go to the Zoom chat and just type what is the T word, the dirty word starting with T that prevents us from using property as the #1 tool for passive income. What is the T word? It's not Taylor Swift, huh? Something else. What is the T word? Yes, Sarah. Hey, those who are in financial consulting, don't answer the question. Allow our friends who are not in the industry to answer. Okay, so it's tax. Okay, tax does not. I mean, it's good. I also own property, but the tax is just going to reduce your yield for sure, right? Okay, so with that in mind, we are drawing boundaries. And then let's talk about risk. So generally speaking, we're going to talk about relatively, okay? Please underline the word relatively lower risk. There's no such thing as zero risk, right? Even bank deposit got risk, correct? Because these are listed companies like DBS, OCBC. There's no guarantee they won't close down. There's no guarantee. There's no accounting fraud. There's no guarantee the company will always make good decisions that keep the money there, correct? So there's no such thing as zero risk. There's always risk. So when we talk about risk, R-I-S-K, it is a matter of not 0, 1 to 100, right? 1 to 100. So it's like what level of risk are we talking about? So tonight, everything we talk about is relatively lower risk, okay? Those relatively higher risk things, like Forex options, buying individual stocks, all these, we can discuss with you outside the webinar, okay? So relatively lower risk. Okay, now, I would like you to answer my question. Okay, we keep it interactive. Okay, who here, okay, already, without attending this webinar, already has passive income instruments? Like, for example, you're already renting out a property, a room somewhere. Can you please put one in the chat? Okay, put one in the chat if you're already having some form of passive income. By the way, if you are Singaporean or PR, you must put CPF, okay? That one, we're very lucky. We're born in Singapore or you move to Singapore. It is very wonderful. Yeah, because at least if you are not so savvy in finance, you have CPF as your passive income instrument. So please at least put one if you have CPF. Okay. And then if you have something other than CPF, can you please put two? Put two if you have another kind of instrument other than CPF. Okay, then put two. Okay, please keep it flowing. We want to make it fun for you and energetic and engaging. So that's why we ask a lot of questions. Okay, so we see a lot of CPF, 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 CPF. Okay, Estelle has something other than CPF. Sifu has something other than CPF. Maggie has something other than CPF. And Anita, something as CPF. And Sarah was okay. Very good. Very good. Give yourself a pat on the back. Okay. So at least you have started something. Okay. So let's get ready to type number 3. Who here, okay, after doing some very rough calculation, you have this feeling that you should increase your monthly passive income? For example, you add all your property investment, stock dividend, and all together, maybe you have about 3,000-4,000 per month. Then you feel like 3,000-4,000 not really enough. You might want to have 5,000-6,000 or 7,000-8,000, right? When you retire. Can you please put number 3? I repeat the question. If you feel in your heart, right, in your soul, in your body, that you should have more than the current passive income, you want more than the current passive income, at least $500 more, or $1,000 more, or $2,000 more, please put 3. By right, everybody should type 3. If not, you don't have to join this webinar already. Yeah, you can go and sleep or go and go for jogging, right? So everybody here should want more, right? We're not being greedy here. We just want to be abundant, right? I love this word, abundant. Abundant means more than enough. 年年有余, right? Abundant. That means when your friends or relatives or your future children come to you and say, Papa, Mama, can you help me? You won't say things like, oh, 我心有余力不足. Like, oh, I'm so willing to help you, but sorry, my bank account no money. Okay, you will always have some extra to help. And if some of us don't want to help one, don't worry. You have some extra to go for your extra holiday, right? You have some extra to eat something nice without thinking twice, right? Go Din Tai Fung, go Hai Di Lao, go Swensen, nothing too expensive, not some French cuisine. Yeah, but you won't think twice because you have something abundant. And who resonates with this? That you want more than enough so that you can have a freer lifestyle? Please type 4. I promise you this is the last time I ask you to type any number. I know after a while it becomes very irritating actually. Yeah, okay. Also, please type 4 if you want a freer lifestyle. That means you don't want to count the dollars and cents when you retire. You want to be able to watch any movie you like, watch a musical if you like, go to Bangkok for a weekend if you like. Nothing very rich like, wow, buy 4 Ferraris, but at least, right, you feel more abundant and free and stress-free and charitable. Okay, so this is what we're talking about tonight. Okay, now, what led us to start this webinar in the first place? This is free, right? None of you paid anything for this, right? So Yuan Tai, Victor, and I are professionals, right? We do this for a living, right? We pay bills, we pay our mortgage using what we know, right? Our knowledge. But tonight is free, totally free. And at the end of tonight, we're not selling you anything also. We won't say like, oh, you join our boot camp, $5,000, and then count down 10 seconds. If you join tonight, only $2,000. Don't have, okay? You'll be a bit disappointed if you want to join our investing bootcamp because we have no investing bootcamp. Okay, so tonight we're going to share everything we know with you, but bearing in mind that a lot of numbers are sensitive, like your salary is sensitive, your cash flow is sensitive, some of your health condition is sensitive. So we'll do it one-on-one, okay, privately. Yeah, so tonight is a lot of generic information based on what Yuan Tai, me, and Victor have been doing with our family. Can So why do we do this? We do this because we keep reading news that Singaporeans are not prepared, that Singaporeans have mental health issues, that Singaporeans are burnt out, that Singaporeans are trapped by our job. And when I say Singaporeans, it refers to PR also. And it also refers to people who are not yet PR but working in Singapore. We are all like burnt out. The only time we could stay at home all day is during COVID, like lockdown, right? But now, wow, have to go back to work 3, 2, 4, 1, and some companies already force us to go back to work every single day. Right? And then all of us are just dying to go for our next holiday, but cannot. Bank not enough money to pay off the entire property, still need to work. And some of us got young children, still need to pay for their university. Right? And then Seedly is a very famous and popular blog in Singapore. It's independent, it's not linked to any insurance or asset management companies. They did a survey and say that Singapore cannot retire at 65, right? You think you can, but actually cannot. The amount of money not enough, which is why CPF recently went through changes. Later, please hold on as Victor Fong, our expert in CPF, will be sharing some of the changes of CPF. I know about 10 of you tonight came specially to learn how the CPF impacts your retirement. So please don't just leave soon, okay? Please stay on at least until Victor explains it. Right? Why did CPF go through changes? Because the government, our Jinghu, calculate and realize cannot. Right? Our citizens, if they continue like this, when they retire, they will hate themselves, right? Not enough money. Buy Cai Peng also a bit stretched. So they changed CPF. Okay, these are some statistics that we found online. Okay, all very public information. The median family in Singapore earns roughly 10,000, about 1,200 lah, 10,000 plus, okay? Yeah. And this assumes 2 people working. So you can see quite obviously who's working in this photograph, right? The middle-aged man and woman are working. The 2 daughters are not working. The elderly parents retire already. This is called a sandwich class. Although I cannot hear you, just for fun, repeat after me. Sandwich class, okay? Yeah, so on top of us got parents, below us got children. Some of us got fur babies, cats and dogs. So you need to earn enough to provide for your own food, plus up there, plus down there. Very gangko, okay? Sorry, sometimes I talk about Hokkien and all that. Even Taylor Swift speak Hokkien and Singlish. What you want me to do? So I will also break into Singlish once in a while. Okay, now, question time. How much do you think a family like this spends per month? Based on national median. Median is something like average lah. Okay, in mathematics it's different, but just treat it as average. Okay, so every month, what would be an average or median spending expense? Come. Make a guess. Make a guess. Without Googling, without using ChatGPT, make a guess. This family of elderly parents, middle-aged parents, and children spend how much per month? Don't overthink, don't overanalyze, gut feel, right? Especially if you have family, you have elderly parents, and you have children, you should know roughly how much, huh? Sairam says 6K, Sharon says 6K. Well, all of you read from the same textbook. It's 6K. Wow. Great minds think alike. Okay, which means the cash flow. Some of you are very familiar with the word cash flow. Some of you not so familiar. So cash flow means your income minus spending. And when I say spending, it includes everything, holiday lah, buying clothes, bao ang bao, right? Paying mortgage, paying for your car rental, all in. This is called your monthly spending. Don't forget insurance premium. Okay, whether you pay annually or monthly, all these are your monthly spending. If you pay annually, just divide by 12, okay? By the way, if you have never calculated your cash flow, after tonight, for goodness sake, you owe it to yourself, you owe it to your spouse, you owe it to your children. Please calculate your cash flow, okay? So this family, median family cash flow is $48,000 per year. If you calculate your cash flow and you don't even have $48,000, means you're below average in Singapore. Okay, nothing shameful about that. I used to be very poor. Just in 2014, 15, 16, 3 whole years, I was living in poverty. Right? I had to borrow money. So nothing shameful. Yeah, but you need to be mindful. It's a bit like obesity, right? There's nothing shameful. We're not doing body shaming here. Right now, I'm slightly obese. Yeah, but we need to be mindful. Because if we are not mindful and we continue to have very low cash flow, then you can say goodbye to your retirement plan. In fact, one day you may even be a burden to your children. Okay, so what happens to the 48K of cash flow for the median family? Only a small percentage, 5%, is choosing shares, like US shares, Singapore shares. When I say shares, it means really picking stocks, picking stocks. And then 15% is in some form of mutual fund, unit trust, savings plan, right? If you have any friends or cousin or sibling that is either a relationship manager in a bank or an insurance advisor or a fund manager, definitely at some point they will have talked to you about this already, okay? And if you believe in them, trust in them, of course, you would have signed something by now, okay? So 15% goes into this savings. And by the way, don't call this kind of thing spending, Some of us a bit confused. When you pay for insurance premium, like your term plan, whole life plan, mortgage plan, hospitalization plan, these are called spending. Spending, right? This is like buying, paying for your electricity and your water bill. This is called spending. Because if you're not sick, you will never see the money back. And I'm sure most of us don't want to be sick. So you just happily spend the premium without wanting the cancer insurance to come back to you, correct? But when you put into savings plan, even if it's issued by any insurance company like AIA, Manulife, Prudential, Great Eastern, these are not spending. Correct or not? You are actually taking money from your right pocket and putting into your left pocket. It is your money, just that it is future money, right? You're saving yourself 10 years, 15 years, 20 years, so that next time retirement, you have more money. So don't call it spending. Okay, starting from tonight, be very clear what is spending, like spending on your car, on your clothes is spending, and what is saving and investment. Things that grow in value, that come back to you, okay? Please be very clear. And who's agreeable with what I just defined? Can you please put yes? That means learn to differentiate spending from saving and investment. Okay. If you agree with me, just put yes. Okay. Don't lump everything that you pay to AIA or Prudential as spending. Okay. It's very unfair. You know, I have friends, very educated friends. Some are even MOE teachers. They tell me, I'm spending too much already. I keep paying Prudential, AIA, NTUC income so much per month. Hey, this is ignorance, right? I mean, it's like not educated, sit in the kopitiam, like you want to complain. Right. If you are educated, you wouldn't say things like that. Okay. Learn to differentiate what is spending and what is saving and investment. Okay, I don't want to sound too naggy. Sorry about that. Okay, so 80%, which is the remaining, is in fixed deposit. Okay, and in cash. Fixed deposit are 6 months, 12 months, 24 months. Those are called fixed deposit. Or some are in treasury bill. Some people are quite slightly more savvy, treasury bill. Some are in Singapore saving bond. Yeah, but basically 80% is not growing much. Okay, whether you bought fixed deposit, treasury bill, or Singapore saving bond, all these, the growth is below inflation. Also, they are not really growing. We call it real dollar value is not growing. Right? Maybe it's growing at 3%, but the real dollar value is not growing because it's below inflation. Okay, so JC1, I took economics. This is the first time I hear the word real dollar value, real growth, REAL, real, or net growth, net growth. And a lot of people will say, but I studied engineering, I studied what? Mass comm, I studied doctor, how I know about finance? I don't know. Okay, please, you have internet in your pocket nowadays, right? All of us carry a smartphone. There's no excuse not to know. Okay, you don't know how to do coding because you're not software programmer, but you cannot don't know how to save and invest because this is your hard-earned money. So after tonight, no more such excuses. But if you continue to have this excuse, nobody can stop you also lah. Okay, yeah, Yuan Tai, me, and Victor, we are not just doing financial consulting, we also are coaches. So every time we meet people, not just for money, right? Sometimes it's family issue, sometimes it's parenting issue, sometimes it's career issue. And we keep hearing people with excuses, right? Like, oh, I cannot talk to my boss because I am lower rank. Oh, I don't dare to talk on stage because I'm introvert. Like a lot of excuses, man. If you are full of excuses, you cannot grow. And if you cannot grow, all the knowledge in the world is not going to help you. Okay, so promise to yourself after tonight, you will grow in your financial knowledge, not just knowledge, your financial action. But if you are stubborn, you continue to not want to take action, not want to learn, not want to grow, I'm very sorry. You will continue to be trapped by your active income. Even the highest paid salary, like those CEO level one, those like 50K per month, 80K per month, they paid a lot. But the moment they quit from 80K per month, 50K per month, it dropped to zero. Okay, so don't think your salary is so wonderful. By the way, I used to have 25K per month in Hong Kong, but in Sing dollar. And then just overnight, they asked me to leave the company, so it became zero. Right? So please don't think that your job will last forever. Learn not to be trapped by your job. And then number two, you cannot retire at 65. This one I already mentioned. And CPF doesn't give you much. Later, Victor will calculate for you. Recently, there's an increase, right? There is an increase, but the increase is not much. Okay, Victor will share with you what's the increase. And finally, this to me is the worst sin of all. I got 3 kids of my own, right? The last thing I want is to be a burden to them. I don't want to one day go to my son and say, sorry, Papa, no choice, I have to sell my house. Can I stay with you in your room? I don't want, okay? And then the worst thing is my son say, sure, you can sleep in my storeroom. Wow, jalat. Actually, storeroom not bad. Well, imagine sleep in the common toilet. Wow, lagi jalat. Okay, so who here is similar to me? You do not want to be a burden to your children. Can you please put the letter P? P. P for parent, P for promise that I will not be a burden to my children. Put the letter P in the Zoom chat. Okay, Xavier, and then Estelle, Sarah, Kok Yong. Okay. Of course, if you're a parent but you don't mind being a burden to your children, then don't put P lah. Okay, only put P if you do not want to be a burden. Like you make a promise to yourself. You don't have to promise Eugene, Yuan Tai, Victor, anything, okay? We are not very important. You promise yourself that you will work hard, you will take action after tonight, and then you will not be a burden. In fact, you will be a blessing, right? Because when your children sometimes, touch wood, if they get retrenched, they need to borrow money from you for the time being to tide through the challenging period, you have more than enough to pass to them. Okay, so this is my story. I already mentioned to you, I lost my job. Thankfully, I went to learn finance. I stopped. By the way, my degree is not in finance. A lot of people keep thinking I studied finance. I did not study finance. I studied TV and movie, okay? TV and movie. I wanted to be the next Liang Zhiqiang, yeah. Then after I watched a few of Liang Zhiqiang show, I decided I don't want to be the next Liang Zhiqiang anymore. Yeah, so I joined Singapore Stock Exchange. And then after that, I was in finance throughout. But unfortunately, I told you I lost my job. And then I started learning finance over again. Right? This time it's personal finance, not corporate finance, not investment banking. And then my family situation started improving. And then I was featured in the radio and newspaper, sharing all this knowledge with others because I want to spread abundance. Tonight, we are giving away 3 times $10 GrabFood voucher, right? Just for fun, just to keep it energetic. So please remember to pay attention. And when we ask the right question, you answer the right answer, we will send the link to you. Then you can use the link to pay for GrabFood. Okay, last year, the entire overall inflation is 4.8%. So I mentioned earlier, right, that if your fixed deposit is 3 point something, your T-bill is 3 point something, you think it's so high? Sorry, it's not high because the real dollar value is not growing at all. That means net, you're actually losing 1 point something, 1.2 to 1.5% per year. Just imagine you got a big rice bowl and then you keep pouring rice because you work hard, right? But the rice bowl has a hole, right? And then it keeps leaking rice. Then no matter how hard you work, how come my rice bowl never overflow? How come I keep working so hard, my rice bowl always the same height? It's because of leakage. So this inflation is the leakage. I'm sure we came not to be scolded or nagged, but came for strategy. So this is the strategy, okay? Please note down this strategy. This slide is the strategy. Number 1, we need a goalkeeper. For goalkeeper, look like they are doing nothing. They are standing there, 做波, right? Just to use some Singlish, they 做波. That means they do nothing. But when the goal is, the ball is very near to them, then they have to work very hard. So these are insurances. They look like they are 做波, right? Every year you pay premium. You don't know where is it going, whether money is coming back to you. But one day, if there is cancer, there is heart disease, there's disability, there's accident, lots of money, like 500,000, 1 million, 2 million, come back to you. So goalkeeper is very important. Tonight, we're not going to talk about insurance at all. If you're not sure whether you have enough, please talk to Yuan Tai, Victor, or me, depending on who invited you, and let's review. And after review, you don't have to sign anything, buy anything, right? Just review for peace of mind. At least you know whether you have enough. And then after that is defender. Defenders are generally more hardworking. They run around. But again, if the ball doesn't come anywhere close, they do nothing also. So these are the lower risk guaranteed return instrument. Later, Victor will go into detail what these instruments are. And obviously, CPF is one of them. Midfielder, this one is lesser known, okay? It's a huge blind spot in most Singaporeans' portfolio. And Yuan Tai will be explaining what is the midfielder. These are slightly higher risk. We call it mid-risk, but the returns are above average and above inflation. And finally, I will close off and conclude the session tonight by talking about the forwards. These are the relatively higher risk instrument, higher returns. Some are double-digit returns. Yeah, but you must be able to stomach the risk. Okay, without further ado, please put your hands together and welcome our second speaker, Victor Fong.
Hey, thanks, Eugene. All right, everyone. Now, give me 1 minute. Let me share my slides. All right, so I open my presentation by showing you a picture of my family, okay? And also just a teaser of why this webinar tonight will be a bit different from the usual kind of investment webinar you attend. Because most investment webinar you attend, right, is more of a professional kind of seminar where the speaker, they will tell you, what stock to buy or what plans to go for. But tonight, right, I show you a family photo is just to show you, to share with you that very much as much as we are just financial professionals, right? We also just like you. We belong to a typical family, and usually a family you need, a daddy, mommy. Either you're in your 30s, 40s, some of you are in your 50s, all right? Usually both parents are working and then they have two kids, right? So it's typical for me. And the reason why I share this is because we are not going to be like a professional advisor telling you what to do, okay? But rather tonight's webinar is segmented a different way. We are on the sell side of the industry. That means we promote different products, plans for you to, apply for. But tonight, right, we want to be on your side. So we are just like you, okay, family, looking out for what's in the market. So tonight's session is a lot about understanding what's happening out there, especially for my segment. I'll be talking a bit about CPF, and we'll give you some strategies of what you can do, right, to improve or at least increase your retirement income, okay, passive income. And many times I've been having conversation with my friends, clients. I've been doing this for over 10 years. And generally, everybody share the same thing, okay? The heart of the matter is this. We all want to grow our money, but we also want to sleep out at night. Don't you think so? If you're one of them, right, you just say yes, type Y lah, type Y inside. Right? You're one of them, you just type Y. Because we all know that we want to invest our money. We know that we cannot just put money in the bank, correct? Otherwise, why do you think why just now Eugene shared one slide, right? 80% put money in bank. It's because you want to invest but don't know what to invest in, right? Or you're scared that you might lose money. That's why, yeah, since I don't know how to invest, I scared I lose money, then I might as well don't do anything, I just put it in the bank. Right? Tonight I want to open up your mind and say that actually there are a lot of possibility out there. But first you got to be able to take the next step. Okay. So at least understand for my segment, I'll be talking a bit about how to first of all grow your money, but you can still sleep at night. Okay, that's the heart of the matter. Good. All right. Now I've been helping people for 10 over years, helping people make wise money decision. And this friend of mine, Howard and Yolanda, they are a couple. Howard, approached me to ask for some financial advice. So I just had a conversation with him, and he told me he invested in tech stock. And then during the COVID, the tech stock actually rise in value, but after that it dropped suddenly. So he had to hold on to all these losses. But thank God he managed to have all this stock rebound. He managed to make a bit. Okay. Then after that, I share with him and the wife Yolanda. I say maybe you all should focus more on defending your money. Okay, so get more guaranteed returns. So right, so they have been starting their journey to make sure that their money is growing, but not so much of taking risks into the stock market. Another lady, Miko is a real estate professional, and in fact, she has a sum of money that she wants to invest in buying new property. But you all know that there's this ABSD, additional buyer's stamp duty. So she knows that it's not worth it. So rather than put the money that could have been taken away by the government for the ABSD fee, she invested the money, and now she's on track. Okay, on track to have regular income, and furthermore, she used lesser capital. If she invested in property, she have used much more, but she used less capital, and she's still able to grow her money safely and on track for regular income. Okay, so tonight I also want to help you. So this next step is to understand. Now, first of all, because we want to first talk about understanding about selecting. Okay, because I say on your side, right? This is what is going to happen in the market. Okay, we always be thinking about what we want to invest in. Usually, right, if I interview everybody or have a conversation, I just say jokingly say everybody wants to have higher return, right? And then not only that, you also want to have lower risk, right? Anybody want the other way? You want low return, then you don't mind taking high risk. Don't make sense, right? This is very general, and I would say 100%. Everyone will want that high return, low risk, and furthermore, right, we also want the money to be back very fast. Okay, and in fact, if I can have an investment that I invest today, right, tomorrow make 100%, and it's low risk, then why not? I should invest, correct? But don't you think, if you have an investment that fit all three criteria, do you realize that it could be a scam? Right. In fact, I share with you, last time, more than I think probably 10 years ago, there was this Ponzi scheme that was out in the market. Until today, right? This is just a recent news. This is just back in February, just last month only, okay? And a woman lost $6 million in the Shoei investment. In fact, Ponzi scheme work like that, right? They would say that you'll give you maybe 30% return. Last time I have this friend who tell me there's this he's an investor who buy distressed property. He said that these distressed property are people who are like Australian miners. They have bit mining business back in Australia, but because they need cash flow, so they sell their property at a cheaper price in Singapore and then take the money and move back to Australia. So they're able to get the property cheap and then able to renovate and then sell to China buyers. So with the returns and the profits, right, they will co-share. Everybody who participated in this scheme, right, will actually get money every month. So in fact, it was a 30% return. I even have my friend showing me the income statement. Every month, no, he make 30%. So I was very intrigued, but then I thank God I didn't invest. You see, because what happens is this is a Ponzi scheme. The profits were actually from your own funds, right? What happens is the new investor coming with new funds, right? Then they'll pay the old investors. One day when the new funds don't come in, right, the old investor don't get paid, and then the whole scheme will collapse. In fact, until today, more than 10 years until now, it's still happening, right? So at the very least, why I want to share this with you is because even if you don't make a lot of money, don't make a lot of return, but at the very least, don't lose money. Because for you to climb from basement 2 to come back to level 0 is very tough. Other people could be ahead, from level 0 climb to level 2. Okay, so now that we established this, and I think the key thing that gets people into a lot of trouble is because when we select investment, right, we always go for all three, and that's where get people into a lot of trouble. So for tonight, okay, the very first educational tip that you get from me is this, right? Choose 2 out of 3 criteria. If you go for all three, very likelihood is a scam and you will get drawn into it, and then you find that you're going to lose money. Okay, so choose 2 out of 3. It's like you buy, people give this, tell you about this saying, right? Anything that's cheap, good, and fast, right? You cannot choose all 3. Right? If it's cheap and good, cannot be fast. So if it's good and fast, right, they cannot be cheap. Right? Same analogy. So when you choose investment, choose 2 out of 3. Now, because my segment is going to talk about more of a defensive strategy, okay, how you protect your money with low risk. So definitely, if I were to guide you to how to select an investment, right, this will be the key criteria. It has to be low risk. So what kind of investment out there is low risk? Okay, fixed deposit. What you think so? Fixed D is one of them, right? Fixed D, very liquid, right? You can take money back anytime. Maybe you just park it there for 1 year. But the thing is, fixed D don't have high returns, right? Generally, they don't beat inflation. So it's just spare cash for you to hold, correct? Now, what are other lower risk investment out there? How about Singapore saving bonds or even treasury bills, right? Maybe you invest for half year or 1 year, right? 2 years, okay? Then you get back some money. Again, liquid because you can get back money relatively fast. But again, also not very high return. The latest was about maybe 3+%. Right, good. Now you see, because we've been looking at low risk, most of the time when you look at low risk, right, generally they are shorter time frame, is very liquid, you can get money, but the return not high. So in order for us to break this cycle, right, we need to look for an investment that has low risk, not only low risk, but also high return, right? And that's why we came up with this concept called legacy ATM. Now, legacy ATM is not a term that you can Google straight off the internet. It's a term coined by us to share with you this strategy, right, that can give you low risk but with high return. But if I were to put another tick here, right, under shorter time frame, right, then you go back to square one, then become another scam, correct enough? So in order for legacy ATM, this kind of strategy to work, definitely you have to be patient. You cannot expect money to come back very fast, right? I would say give yourself a 10-year time frame, and generally the money will grow for you, right, to give you the passive income that you need. Okay, so now that I established this, let's focus a bit into legacy ATM. Okay, then there's another case study for Kevin and Joyce. Kevin and Joyce, right, were my good friends. They were initially they were so confused at different financial products. They don't know what to invest in. A bit paralyzed. Oh yeah, since don't know what to invest in, I put the money in the bank first. After then, they also prefer to spend time with the kids rather than monitoring stock market. Okay, so I recommend them to focus on legacy ATM strategy, and it suits them very well. So they've been doing this since for the last 10 years, and they're still on track for their retirement goal. In fact, I think they're doing much better than many people who try to go in and out of stock market. Okay, but that's just one strategy. Okay, but for some of you, maybe stock market could be the better investment for you. Let's see. Okay, because Yuan Tai and Eugene will share more on that later. Okay, so why legacy ATM? Because we are very used to ATM. Every month when your salary comes, right, in the past, I will always go to the ATM to try to withdraw money. Nowadays, we use PayNow or electronic transaction. But back in my days, I'm 40 plus this year. When I was in my early 20s, 30s, right, we always had to go ATM, right? You have active income, then the money grows some interest, and then you get passive income because the interest is you will grow the money, right? But it's just not a lot. Okay, so my key question is this: what if your active income stop, but your passive income continue? Okay, and the income continue for the rest of your life. That's why I call it legacy, right? Legacy has this term coined to it. It's like the coin legacy is because I mean the term legacy is coined in such a way that it can last you very long, and not only last long, you can even leave it behind for your maybe your children or your children's children. That's why we call it legacy ATM strategy. Now, if you pay attention for what I'm going to share this later, because later you might win the $10 voucher. Okay, pay attention. Legacy ATM strategy comprised of, first of all, you need to max out your CPF life, which I'm going to share more later. And also couple it with an endowment fund. It has to be 2, right? If you depend on one, it's not a legacy ATM. Why we need 2 to work for you, a twin engine to work for you. Okay, I'll be sharing that in a while. First, let's focus on CPF life, right? Most of you have this question about CPF life, what's happening. Now, let me share the current structure first. Okay, so currently, and there are going to be a lot of numbers from here onwards. If you find that your level you're not very familiar, okay, it's too technical for you, then don't worry, okay? We will arrange for one-to-one Zoom with you, okay, that will explain more in detail. But for tonight, just understand the big picture first. Understand what the whole CPF life scheme is about. All right, generally, it's a government scheme where it allows you to grow your savings such a way that when you officially retire at age 65, right, you will have a regular source of income. Okay, if you have the maximum you can get, right, is about 2.4K as of this year, 2024, right, from 65. But in order for you to have this monthly income, right, you need to be able to be at age 55, set aside 308,000 in your CPF account, right? And it comes from your special account, and then you will transfer to your retirement account. But if you don't have enough from special account, they will take from the ordinary account and transfer to the retirement account. If you are not familiar, it's okay. Just understand that this is the amount that you need. And this scheme, this is called the Enhanced Retirement Sum, ERS. Okay. Now, you may wonder, okay, what if I don't have enough 55, I only have 205K? Then this is what the government is encouraging us to meet. At least, right, if you can hit this full retirement sum of 205K this year, it means that you can expect about 1,006 when you turn 65 onwards. Okay, right? What if you don't even have enough? Then if you have a property, you can pledge the property and then you just meet this called the basic retirement sum, BRS, 102K, but you also get only lesser, okay, $900 a month from 65 onwards, right? And if you really, really don't have enough, right? So at least 60K, because that's a minimum you need to keep. It cannot be fiction. Okay, then you can expect about 500. So this is the full range of income that you can expect from about 500 to 2004, okay, based on the current CPF Life scheme. Now, before I go to what is the change this coming next year, right? Just understand, right, how the government derive this number is basic retirement sum is times 2, right, will be the full retirement sum. Enhanced retirement sum is 3 times. Okay, 3 times. Now, what happened in 2025 next year? First of all, retirement sum remains the same, 2 times of basic retirement. Full retirement sum remains 2 times of basic retirement sum. FRS, 2 times of BRS. Okay, clear? ERS, right, will be raised from 3 times of BRS to 4 times. So just take note of this, right? So this will be the new figure. This is just a main change. Okay, you will have a higher sum that you need to aim for, but it also means that you have a higher income. By the time you reach 65, right, you can expect about 3.3K. Just how we saw, right, is about 2.45K or 2005, right? So if you meet the new higher ERS turning next year, okay, you'll be 3.3K, that what you can expect. All right, clear so far. So that's the main change. Secondly, what is the other change is when you reach 55 next year, or even if you're younger than that, when you turn 55, because next year is going to kick in already, there will be this thing called a special account closure. So all your funds that are supposed to be kept coming from the SA to the RA, right? If you have any surplus left in the SA, right, you can actually earn high interest, but it's no longer going to be there. It's going to be closed, and you'll be transferred to your ordinary account. Now, a lot of people ask me, they are very confused. Okay, what is going to happen? Now, first of all, if you are below 55, just know that your special account won't be closed. Okay, for those of you who are 55 and above, right, special account will be closed, but your retirement account will have already started. Just that you cannot take money first. You got to wait till 65, then you start to see coming up to you in monthly income. And the big hoo-ha about this is because there's this thing that is ongoing in the internet. Many people have been using it. It's like a hack. They say the CPF hack is what happens is before you turn 55, right? If you're able to invest your special account, right? They call it shielding. Put it in an investment such that when the time you turn 55, this money that's supposed to go to your RA, right, cannot be taken from SA. So they will take money from the OA, which is giving a lower interest, to pull into your RA account. After that, you can sell back your investment to put it back to your SA. So when you turn 55 hours, right, you not only have retirement income that's coming to you in monthly income, but you also have your special account that's earning 4%. Now with this special account closure, this one is no longer able to do it. So you're left with money back into your OA account, which is earning about 2.5. And I think you can do much more of it. Okay, so this is the criteria. If you are age 55 and above, if you have met the FRS, and special account that's closed, right, we will transfer to OA, which is earning a 2.5% instead of 4%. Okay, but if you don't have enough to meet full retirement sum, you'll be transferred to your retirement account, and then the remaining goes back to OA. So just very simple now. Okay, whatever account that's in special account when you turn 55 hours will no longer be there. We'll transfer to OA. Now, here's 2 things that you can do. Okay, by the time you're 55, you have enough in the ordinary account, right? You can choose to transfer this ordinary account amount to meet the new higher ERS, which is 426K, as I explained earlier, which means that you can expect about 3.3K from 65 hours. Or you can maintain the flexibility, because OA, once you turn 55, is like a deposit account like that. Anytime you need to withdraw, you can withdraw, right? You just need to click request pay now, and then the money will transfer pay now instantly. Okay, so some of you were thinking, oh, but 2.5% not very high, so do you want to invest? So you can either click the flexibility, invest this OA, right, for more return, which later Yuan Tai and Eugene will share more strategies. Right? I'll tell you about the endowment part in a while. Okay, so these are just the main two options that you can do. Okay, and then you may wonder, but why is the government doing this? Why are they shortchanging people from earning 4%? Right? Actually, is what I've been sharing earlier. See, saving that cannot be withdrawn on demand should earn a high long-term interest rate should be higher. Okay, but anything that is withdrawn on demand should earn low interest rate. Remember about the three criteria: low risk, high return, liquidity. If it's liquid, then definitely you cannot expect high return. But if it's not liquid, then of course you can expect high return. So that's the whole rationale, right? Just how Eugene share, right? Some of the other changes. Last year, right, in September, right, they say that Q4, this is help you boost your special account to 4.04%, and then Q1 this year is 4.08. Okay, so actually you get more than 4%, but then now it's back to 4.05. It's not a lot, but at least you still grow your special account. Okay, now this is what we recommend. Now that you know about CPF changes, okay, you can max out if you have enough resources, right, in your CPF account. You can max it out, but we just don't recommend you to just solely rely on CPF for your retirement needs. Why? First of all, you can only receive up to ERS, the Enhanced Retirement Sum Limit, which is about 2.4K or maybe 3.3K next year. Okay, maybe not enough because you work so hard, you retire not just to live on basic need, right? You definitely want a better life than just eating chai peng, right? Or go JB for holiday. Maybe you want to go Europe. Okay, and before 55, you can only top up to special account up to the full retirement sum. You cannot increase it to enhanced retirement sum yet, but you can keep the money there in your special account first. Okay, but you can only top up. That's a max. Even if you have a lot of money, you have $1 million you want to put in, you also cannot put in because the government job is not to make people into billionaires. It's just to make sure that you all have a decent living. You want the better life, then you do more on other side, not just fully depend on CPF. Again, after 55, with the closure of the 4% CPF, right, your remaining CPF OA only earn lesser 2.5. You can do much more with it, okay, than just keeping the money there. All right, and if you transfer to higher ERS, right, you might lose the flexibility because less cash on hand. So it really depends. If you have the capability to max out ERS and still have extra money on hand, then by all means go and do it. But if you find that it's going to be very stretched for you to hit the higher ERS, we recommend you to at least keep some cash on hand and learn to invest this money that's sitting in your OA. All right, and with that, this is the part that I'm going to tell you what to do with not just depend on CPF Life, is to actually couple it with an endowment fund. Okay, endowment fund usually in the market works like that. Generally, let's say for every $1,000 you invest for 20 years, you need to start saving early. Okay, give it a long time frame. We say 20 years because I think it's a good time frame for you to build up, such that by the time you reach retirement age, you can actually withdraw it, double the amount for the next 20 years. All right, generally it's like that in the market. If you ever explore many plans, right, that's offered by many financial institutions, they generally offer this kind of package. Okay, then if you use less of this money, you can actually leave some behind for your kid. And those of you who are parents, right, there's a way where you can structure this kind of plans whereby your grandkid can also enjoy a sum of money. For more details, right, we recommend you go one-to-one with us, and then we'll share with you more in detail, right? But tonight, just learn the concept first. Why is an endowment fund good? Because capital guaranteed. You keep your money safer, right? Most other plans, right, they don't have a capital guarantee after a number of years. It's still variable depending on how the stock market moves. Okay, but for endowment, generally it's capital guaranteed. Okay, but you got to be patient for it there. All right, and usually you can double your money. Just that you have to be patient. Again, once again, patience is the key. And also it allows flexible lump sum withdrawal, right? CPF Life locks in your money. You got to receive it monthly, but it gives you a kind of safety net. You know that every month you have money. Then with the endowment, you have extra flexibility. When you need, you can do bigger withdrawal. If you don't need, you can park it there and then still earn higher interest than 2.5. Right? So generally, that is the part about the legacy ATM. Right? To sum it up, CPF, let's say you can contribute to the max, right? You can expect, to the max is ERS amount. You can expect about 2.4K, 2.5, or maybe 3.3 next year onwards. And if you do it with an endowment plan, couple with another plan, another 2,000 per month kind of payout. So total, right, you can expect about maybe 4.5 to 5 to even 8K. If it's 3 plus 2 is about 5K. So your first 4 to 5K, right, is taken care of by just focusing on legacy ATM. If it's enough already, you can just stop here. Okay, just hold on to this. right? But of course, you want better, then later go and listen to Yuan Tai and Eugene. We're going to share their segment. It will give you more ideas on what you can do tonight. I mean, do for your planning. Okay, tonight you learn, tomorrow start to learn how to execute. Okay, and with that, I'm going to end my segment with a quiz. Okay, just like I tell you all to pay attention, right? If you pay attention, you will know the answer to this question. What does the legacy ATM strategy comprise of? 4 multiple choice question. Get ready your keyboard, fastest finger win. You only need to type in the number. Is it 1, 2, 3, or 4? Okay, what does the legacy ATM strategy comprise of? And here we go. All right, is it CPF or unit trust, plus saving bond, plus fixed deposit, or plus endowment fund? Wow, very fast, you. Oh, very fast. Okay, which Sifu, C. Mr. or Miss Fu, okay? You are the one who won. Later we will
James.
James, it's James. Okay. Later we will make sure we get a correct contact number, and then we will pass you the $10 Grab voucher through your mobile phone, okay? But for now, let's all pay attention to what Yuan Tai has to share. Okay, and over to you, Yuan Tai. Okay.
Hey, thank you, Victor. There's quite a lot of content. So every webinar we are thinking how can we squeeze it within 90 minutes. Most of the time we fail. But we still try our best. Yeah, because there's so much that we want to share, and there's a lot of strategies that we hope that you guys will be able to utilize and apply. So all three of us, Eugene, Victor, and myself, we actually employ all the 3 different strategies that we share. But of course, for time purpose, then we divide and we just share one each. So for myself, I'll be sharing the zero tax rental strategy. Let me share my screen. Okay. So this is a Straits Times article. I was interviewed by Straits Times and my wife and myself. So I think a few of us are married and some even are parents here. It's very important to manage our finances together as a family. Headlines. So this is a few days ago, the article. S&P is at an all-time high, but you should stay invested. Okay, I brought this article to bring out a very important point. So a lot of us invest in stock market. I myself included. In fact, I started my investment journey when I was studying in NUS in 2007. So then there's some of you may be familiar. There's this platform called POEMS. So with the money that I saved up from tuition and giving tuition and army, I started my investment, and of course I paid in tuition fees. Yeah, so I even till today I still do individual stock picking. But the point for retail investors is often we try to go in, buy low, sell high, but very often our emotions will get into play. So over the last 3 years, we see the stock market actually pretty volatile. And this article shows that S&P 500 now at all-time high. So what do we do next? Do we sell? Do we take profit? Or do we stay invested? Okay, the answer is I'll review later. Okay, case study, Mr. Andy. Mr. Andy is fictional, but this is a real example. He bought a condo. How much did he pay for it? 1.27 million, 2019. 2-bedder, about 764 square feet. So he was paying up to 4%, 4% plus. In fact, during the peak, the interest payments almost reached 5%. And that actually took a lot of people by surprise because they are so over leveraged that they have very little room for error. And easily, if you are paying over 1 million plus for property and you are taking like close to like 800,000 or even 900,000 in terms of mortgage, that increase in a few percentage points can literally mean 1,000-2,000 per month, which is very significant. So if Mr. Andy bought a condo, you have to pay the interest payments in terms of mortgage interest, which is pretty high. It's come down a bit now. It's about 3%, plus minus a little bit. But I personally think that you'll be around this level. No longer will see the 0 to 0 point something interest rates for the past 10 years or so. Yeah, no longer will see that. And it is worrying for young people. Consider myself still young, born in 1980s, but it's increasingly difficult for young people to own property and to use property as an asset for asset progression. It's more and more difficult. Rental yield about 3%. In terms of Singapore rental yield is about 3%. Mr. Andy, he had to pay income tax. So don't forget rental income you have to declare and you have to pay income tax on that. And of course, he's paying about 200 plus, close to 300 per month in terms of conservancy fees. And importantly, ABSD, which is 21%. So Mr. Andy, if he's buying this condo as investment property, a second property, immediately out of pocket, he's already down 21%. So 21% of 1.27 mil, I leave you to do the math, is a lot. Option number 2, Mr. Andy, he can do REIT. So those of you who are not familiar, what is REIT? What is a REIT? REIT is a real estate investment trust. Basically, these companies, they pool together a sum of money and then they buy properties, commercial industry and industrial properties, and they rent them out for rental income. So it's also an option for Mr. Andy. If you don't want to buy a physical property, he can invest in REITs. But what kind of returns is he looking at in terms of REIT? So REITs is pretty volatile. You can see in this pretty recent article. Why is it volatile? Because these companies also borrow money to buy the properties. So they also leverage. And of course, over the past 3 years, interest rates have crept up. Higher borrowing costs, which means their margins are actually being squeezed as well. How have REITs performed for last year, third quarter? You can see it's volatile, really volatile. Have fallen nearly 7% for last year, third quarter. And what are the REITs doing in terms of the best REITs? Of course, the best REITs are doing pretty well. 7%, you can get 7% in terms of returns. But here's the huge but, the fine print. If you choose the wrong REIT, you are easily down double figures as well. So if you are investing in the REITs, a lot of people underestimate the investing in REITs. You actually do need to spend time and energy to really look at spreadsheets and numbers and research on it and then find the right REIT. So it's not a sure gain, surefire. Okay, so option number 3, Mr. Andy can actually employ something called the zero tax rental strategy. So this is neither only a physical property nor investing in REITs. It's actually using funds as a vehicle. And I'll explain to you why funds is a good choice in terms of zero tax rental. So how much does Mr. Andy have to pay, or rather have to invest if he's employing this strategy? About 1,000 every month. So you can set aside 1,000 every month for 12 years, about 12K times 15 years. Let's say you invest in it consistently for 15 years. That's about total of 180,000. Still much less than a property, because 180,000 you can probably only buy one room or half a room. In terms of yield, he's looking at 5 to 6% in rental income. It's a rental income because he's not actually buying a property by investing in the funds. So if he chooses a dividend paying fund, he can get 5 to 6% in terms of the dividend use. So Eugene, Victor, and I, we are on this platform called the iFast. We have access to a lot of funds, a lot of funds. But we help you to shortcut some of your time and energy, because we love to spend our time and energy with our families and doing hobbies like hiking. And of course, for myself, I love to volunteer. So I don't want to spend too much time as well to look at spreadsheets, even though I do enjoy that. So that's why we employ this zero tax rental strategy to look at funds, and then we shortlist for you. We'll do an in-depth case study in the next few slides. But what is Mr. Andy getting in terms of yield? 6 to 8% in terms of yield by employing this zero tax rental strategy. And the best of all, he doesn't have to pay income tax, no taxes, no property tax, no ABSD. And I myself, I also invest in property, but not in Singapore. I invest in overseas property. That is actually a high risk category because you are subject to the exchange rate as well, and you do need to have context. But I have experience getting property and renting them out, and let me tell you, it's not really a cup of tea. Yeah, recently I just had a conversation with one of my single friend who is looking at getting a property. as an investment because the single friend is still staying with the parents, so can purchase a property, use it as an investment. Then I tell her, will you be willing to handle all the headache and stress of renting out property? Because trust me, those of us who have invested in property, we know that it's not so easy. If you get a good tenant, all is good and well, but if you get a nightmare tenant, that's good luck to you. And end of story, good luck to you. The tenant will trash your place and destroy all your place. And at the end of it, your rental can probably just cover your repair costs, your renovation costs. And of course, if Mr. Andy choose to employ this zero tax rental strategy, you get some bonuses as well. So how do we choose a good fund? So this is zero tax rental strategy writes on funds, and we need to understand some fundamentals. I know some of you have lots of experience, but some of us here may not have experience. So let me just go through briefly what are things to look out for. Expense ratio. Expense ratio basically in layman's term is how much the is being spent in terms of advertising, in terms of marketing, in terms of managing this fund itself. So of course, the less spent, the better is the expense ratio, because this also affects the margins and the returns that we are getting from these funds. So looking at expense ratio, a good expense ratio for a fund is usually between 0 to 2%, but I'll usually look at anything that's 1% or less. That I'll consider a good expense ratio. So past performance, of course, past performance doesn't determine future performance. There's always a misconception that people based on past performance. But past performance, looking at the fund, how has it performed in the past, does give us a very good indication of the management team. Is this a management team that knows what it's doing, or do they not know what they are doing and able to deliver performance? Fund manager experience, and of course the assets under management, which is total fund size. So generally the rule of thumb is that the bigger the fund, the better it is, because it's less likely that this fund will disappear or close down overnight. Yeah, just now Victor mentioned scams. There are really a lot of scams. So some of the funds, they are not regulated by MAS. They can just close down overnight. But rest assured, anything that is recommended by Victor, Eugene, and myself is well regulated, and we put our money in it as well. So 3D strategy, let me just add value and share with you quickly what's a 3D strategy. So this is a negative example. Why is it a risky fund? You can look at it, it's quite obvious. It's heavily into one sector, which is bonds. So this particular fund is like 80% into bonds. And of course, due to the high interest rates, the bond price is conversely related. So it has gone down quite a bit. The returns is negative double figures. So this particular fund is actually, while it is into bonds, seemingly quite safe because it's too heavily into bonds. It's pretty risky. And of course, the returns are not fantastic. You can see from numbers. So an example of a good fund, we have done our research. We have narrowed down. Just take note that this is not a stock recommendation. But we use this as a case study to understand what exactly is a good fund for us retail investors who want to sleep well at night. So employing a 3D strategy, diversification is the first D. And we are talking about this Allianz Global Investors Fund. Why is it a good fund? Why do we recommend it? Why is it 5-star Morningstar rated, which is an independent rating agency? Basically, it's the best in class. And this is why. Reason number one, you can see that it is 1/3 into bonds, 1/3 into convertibles, and 1/3 into equities. So it's already well diversified into 3 different classes of assets. And you can see from performance, the yield since inception, this fund has been around since 2011. So it's 13 years already been around. About 7% in terms of the yield, annualized returns. But of course, if you look at the numbers in the short term, it's pretty volatile. So it can range from 2% to 7%, is up and down. But right now, what we are recommending and what we believe is for retail investors, let's not try to be too clever. We try to time the market and everything. But if we give ourselves mid to longer term, we can actually then give ourselves more chances of making profits. Just now I mentioned earlier on, A lot of us try to time the market. We try to time it when the prices are low, then we go in, and then prices are high, then we sell. But the fact of the matter, even the experts, even those with PhD, even those with decades in the stock market, they cannot tell you when the crash is coming. Nobody predicted when is COVID. Nobody predicted when is Ukraine war. And nobody predicted what will happen next. What is the next black swan? So give ourselves a longer period of time. Give ourselves mid to long term. Just park our money aside. And then that's where we really make the returns. Yeah. The three of us here, we are all family people. We are married. And Eugene, Victor, they all have kids. And I myself will have kids as well. So we are really, really concerned that people are really making very dangerous decisions. They think that, oh, I want to time the market or I want to in and out, but then they end up subvoing themselves. So give yourself a mid to longer time span, that's where you can make the returns. So first D for these Allianz funds is diversification. You can see it's well diversified. In terms of risk reward, it's very comparable to something like the S&P 500. Those of us who don't know what's S&P 500, basically is an index that tracks the 500 largest companies in the US. So Allianz fund is 1/3 into equities, and these equities is then subdivided into 500 different companies. So it's really, really well diversified. Okay, the second D is dollar cost averaging. So Mr. Andy, he employed this dollar cost average strategy. He set aside 1K every month to invest into this particular fund, this zero tax rental strategy. Yeah, you can see, of course, there's up and down. The chart always there will be up and down, but if he employs a dollar cost average strategy, he can easily take emotions out of the question, and then he can make returns, very steady returns. Finally, the last D, I've already mentioned somewhat, to give yourself a longer time span, 10 to 15 years or even more. And that's where, as retail investors, then we can make the odds in our favor. And this is really a smart strategy to employ to give yourself longer duration, which is why it's very important. When is the best time? People ask me to start investing. My answer is yesterday. But yesterday we cannot do anything about it. So when is the next best time? Today or tomorrow. Take action as soon as possible. Because in the blink of an eye, we're already in March 2024. We are Chinese New Year, we are gone already. We're already almost a quarter of the year gone. So time flies very fast. And if after today's webinar, you don't decide to take any action, there's already one day less to your retirement or to your desired financial goals. So my advice to you, quickly decide, take action. Okay, give yourself more time, not less time. Some people, they ask me, they are already like 55, 60, and then they will probably only have 5 or 10 years. Very little time, still can do something, but options limited. So you have 10 years, you have 15 years, 20 years, please, please, please take action for yourself and for your family. Okay, this is a summary table to sum up everything. So what are the options that Mr. Andy can do? So I myself actually do all 3 of the options. So number 1 is property. You can invest in property. Of course, that requires a huge outlay, huge down payment. Of course, you have to subject to the taxes, and you looking at 3%. Of course, people invest in property for the capital appreciation. So you do actually have to hold your property for a long period of time to realize that capital appreciation as well. REITs, Mr. Andy can also choose to buy REITs, but he has to do the research. He has to look at the numbers. He has to look at the spreadsheets, because if he choose the wrong REIT, easily he can be down double figures. Zero tax rental strategy, looking at that, using funds as a vehicle, and you can get returns of 6 to 8%. Okay, quiz time. But before that, let me just share with you one of the real life example. So this is my friend, Mr. Ken. Some of you who are foodies or you love to spend time in the kitchen to cook, you may be familiar with this very long time old brand called the Nanyang soy sauce. In fact, it has been featured in TV and media before. So his family business is this Nanyang soy sauce, and they actually spend months just to brew the sauce, the soy sauce, traditional. His factory is somewhere in Jurong Jurong Tuas near the Jurong area, Boon Lay, that side. Yeah, I've been to his factory before. So it's a traditional family business. He wants to spend his time and energy maintaining his tradition. He loves it. And he loves to spend time with his family as well as two beautiful girls. He don't want to spend time sitting in front, like me, in front of the spreadsheet and look at the stock market. He doesn't want to do that. So zero tax rental strategy help him to preserve and achieve his financial goals. Quiz time! What is zero tax rental strategy? Fastest fingers first. Okay, type inside the chat box. Fastest fingers first. Okay, well done, Letitia. Well done. Congrats. Okay, so we are running like a bullet train. Let me just hand over to Eugene to wrap up the entire segment.
Thank you. Yeah, sorry. Those who join us at 8 p.m. You know, I already warned you. It's really, I tell you, info overload. Yeah, but we want to be abundant. We don't want to take away any info. Everything that we share is important. Not everything, of course, is appealing to you, lah. We understand, yeah. But you know, I promise some of you, right? You're my personal friend. I told you at least one. Okay, one. Okay, everyone, please share one. Right, at least one idea that you have heard so far from Victor and Yuan Tai would be helpful. Okay, please write down what is that one idea. Okay, so for myself, I promise some of you that I will share my own personal family strategy. So what I did is I actually got an endowment similar to what Victor said. Yeah, because that one, of course, the so-called negative side is it's not so liquid for the first 15 to 20 years, but it's okay. It's like CPF lah. CPF is also not liquid, right? In fact, it's longer than 15 to 20 years, right? CPF is not liquid all the way until you're 55. Yeah, and then after that, Victor already explained, one big chunk is not liquid until 65. The rest is fairly liquid. Yeah, and then I did that because I used to be from Singapore Stock Exchange. And then I think one of you also was my colleague in Singapore Stock Exchange. And things are a bit cowboy one. People buy sell shares based on speculation. And even after they did the calculation, sometimes their emotion cannot allow them to hold on to their belief, and then they sell at the wrong time. And then sometimes things are unexpected. They thought it's a very good company like HiFlux, but the company closed down. Right? I mean, nobody really expected HiFlux to close down. Yeah. So things are very unexpected. So I decided, okay, I'm already 48 years old, by the way, 48, in case you're wondering. I don't want to take on more risks. I want to take on less risks. So I actually bought a lot of endowments. I got 3 children, so each of my children got 1 endowment each. And it's a legacy. That means I'm the owner. I'm the person who put in money. So I have every right to take the money out after 20 years for my own retirement. But if I have really too much money, right, then I won't go and touch it lah. Then it will be my 3 children who will enjoy it when I go to heaven. Yeah, so that's why it's called Legacy ATM. And then I also got what Yuan Tai said, not the risk part. By the way, our team used to be the ones launching REITs and ETFs, back in about 20 years ago. But now I don't want to touch REITs anymore. REITs got a very bad reputation. The yield is low. The risk is high. The prospect is uncertain. I don't want to touch REITs anymore. Also, I got into the Allianz Income Fund. I put my personal money, got into the Allianz Income Fund because I really, really love the fact that every month I get money. Right? You think about it, which other plan, which other instrument, which other investment gives you monthly dividend? Some are quarterly dividend, some are annual dividend, some don't get dividend until like 10 years later. This one is the very next month get dividend. So it's really better than renting out my property. And then I'm not afraid of like what Yuan Tai said, someone trashing my property, because the Allianz Income Fund is a purely virtual fund. That means it's all dollars and cents on your screen, right? There's no brick and mortar for people to trash. Yeah, so my own personal money is in Allianz Income Fund as well. And then the third thing I am in is something I'm going to explain now, okay? So please pay full attention as I wrap up the last 15 minutes. Okay, so this is the strategy that we were talking about. Y'all can see, yeah, okay. So just now, Victor shared the first part, and then Yuan Tai shared the zero tax rental, and then I will share the higher risk part, okay? So here goes. The higher risk includes overseas property. This one, Yuan Tai touched on it. I'm not going to elaborate too much. But I'm pretty sure by now, a lot of you have seen flyers, posters where other people, right, will have prospected to you, say, hey, why don't you buy London property? Why don't you buy Japan property? Recently, there's even something, they use containers, right, to put into, like, they call it what, tiny homes in Australia, right? So they put in the middle of the forest, then they ask you to invest in that as well. So nothing wrong with all that, but the problem is we're physically in Singapore. So sometimes you're wondering like, hey, what's going on with my Manila property, my Australia property? And then you want to go there once a year to visit. So be it, okay? But don't forget to count in your travel costs into your yield as well, right? To be fair, to compare apple to apple. Yeah. Oh, Dawn asked a question about iFast. Very good. Just now nobody thought about iFast, but don't worry. Basically, iFast, just treat it as a normal brokerage platform, and you can buy any fund you like on iFast. But the problem is, it won't behave like CPF. That means there's no disciplined approach. You think that you're going to put in monthly, but sometimes you forget, sometimes you don't care, sometimes you prefer to use the money for holiday. So it is far too flexible. Okay, then number two, there's no protection element, right? Because just now we may not have time to talk about it. Yeah, but your money is at least protected in case of death. So when I pass on, my 3 children will still see every dollar I invested in the Allianz Income Fund pass to them. You know, rather than if I buy through iFast, there's no guarantee that when I pass on, the year that I die will be just nice. Wow, the money will grow, right? So I may die in the wrong year, and then my children inherit a lower amount. That means I put in 200K, but they only inherit 160K. So I lost 40K simply because I died in the wrong year. Okay, so these are 2 reasons why I chose to put into the more structured approach than to just buy from iFast. But there's nothing wrong with buying from iFast. It is fully liquid. You can buy today, sell tomorrow, just that it doesn't have the benefits I said earlier. Okay, so hopefully I answered your question. And then the next one, franchise MLM. Again, I mentioned this at about 8 p.m. Right, it is very, very time consuming. Right, some people call it passive. I'm very sorry, right? This is not my definition of passive at all, right? Because you still have to make sure the labor didn't, the manager didn't steal from you at the Subway chain, at the 7-Eleven store, right? You still need to manage it, right? You are like a businessman, you are an entrepreneur. You cannot say you're sitting at home waiting for the money to come in. You must be honest with yourself. And then stock dividends is truly, truly passive, right? You don't have to hire anybody, rent any place, but very volatile, right? Because stocks only give out dividend when they make profit. So what makes you so sure that that particular stock you buy will make profit year after year after year? Even the CEO not so sure, How come you're more sure than the CEO? So if you go in for a short while, right? Like if you are very sure you got some insider news or you did some analysis, then maybe enjoy the dividends for 3-4 years. But there's no way on earth you're going to enjoy the dividends for 20 years, 25 years, 30 years, right? It's close to impossible. And even then, the dividend may not stay high. When I say high, remember? Hey, anybody remember the inflation I showed you earlier at about 8:15 p.m.? Can you put the inflation number? 2023 inflation. Financial consultants do not put number, only non-financial consultants. Please put the number I showed you in a newspaper report at 8:15 p.m. Wow, Xavier, congratulations. Yeah. Oh, but sorry, I haven't wanted to give out the voucher yet. Yeah, later I got another question. Yeah, but Xavier is correct. It's 4.8%. Also, imagine stock dividends. If you must be super lucky, or your mathematics must be very good to get one with dividends higher than 4.8%. Right? A lot are chugging around 3 to 4%, 3 to 4%. Maybe some small cap, some semiconductor firm is giving out higher, but then because they are small cap, right? Small market capitalization, these companies also like can disappear anytime. Yeah, so be very, very careful. Okay, as you can see, I am very biased against overseas property, biased against franchise, and biased against stocks dividends because of my personal experience. I have burned my money before. But I am very, very for leverage annuity. Okay, simi lai. What is average leverage annuity? Okay, let me tell you. Okay, forget about the franchise. This one I'll skip. Okay, stock dividends also not very high. You can see. Okay, even the highest is only 6 to 7%. Nothing to shout about. Okay, skip. Okay, now let's talk about leverage annuity. I'm left with last 9 minutes. Let me slow down. Wow, some people complain already. They say, oh, Eugene talk so fast, cannot catch anything. Okay, slow down. Okay, so the word leverage means you need to take a loan. Okay, don't throw anything at me. Okay. There's good loan and bad loan. So if you take a loan to buy Prada, buy Porsche, buy Tesla stock, that's a bad loan, right? Because there's no certainty of paying back the loan. And then if you borrow from Tai Long, loan shark, and then they charge you double-digit return interest, that's a bad loan, right? People will splash paint on your door and then cause divorce, cause your children to be abused. So that's a bad loan. But there's something called a good loan. Okay, hear me out, because Asians generally don't like to take loan, except for property, no choice, because you can't fork out $2 million to buy a property, so no choice, have to take loan. But when you have a choice, then why would you take a loan? Okay, so hear me out, hear me out. So please put on your imagination hat, everybody. Okay, imagination, Now imagine that OCBC, I'm sorry I have to name a bank here because only OCBC is willing to do this, okay? None of the banks is willing to do this. So OCBC is willing to loan you $180,000. Legit, legit, okay? You put on your imagination hat, OCBC lend you $180,000. Okay, now, what OCBC tell you at the bank is this, Just imagine you're seated with the relationship manager. By the way, I don't represent OCBC, okay? Everything I say is from actual facts, right? I'm not representing them. Now, $180,000 loan, my greatest fear as a father of 3 is that they are forcing me to return back $180,000. Like, where am I going to find $180,000? Right? Even if I have, I will be spending on my children's education rather than return back to OCBC. So the good news is, listen, okay, ladies and gentlemen, later I'll be giving you a quiz question. The good news is OCBC does not need you to return them the $180,000. Okay, this is mind-blowing news. This is the only loan I know in Singapore. I don't dare to comment about any other country, okay? Where the bank does not require you to return the principal. I tell you, it sounds so ridiculous. It sounds like a scam, okay? But it's true. You can Google about this. I can even send you YouTube videos to watch. OCBC loan you 180K, don't need you to return the 180K until you die. Now, I'm a father of 3. I don't want to be a burden, remember? So after I die, I don't want my children to have to borrow money from relatives to return 180K also. So the good news is an insurance company, okay, will be paying OCBC $180,000. Also, this is guaranteed. As long as I die, they check that, I'm not breathing anymore. Okay, then they will pay $180,000 to OCBC. So imagine while I'm still alive, I don't have to worry about the principal loan at all. Okay, I really don't know any loan like that except for this OCBC one. And then they, of course, need to earn money, right? OCBC is a listed company. They need to pay their CEO their salary. So I need to pay interest, okay? How much is the interest? It's very stated there already. Anybody can see the interest? Let's test your comprehension skill. Close passage. What is the interest that OCBC is charging you for the $180,000 loan? Come, ladies and gentlemen, my $10 GrabFood voucher starts now. What is the... Wow, Sharon, congratulations. Okay, sorry, Sairam, you are one step. Okay, I'm very generous. I'll give both Sharon and Sairam, okay, from my own pocket. Okay, so both Sharon and Sairam get a $10 GrabFood voucher each. Okay, just for fun, of course, you can more than afford a $10. Okay, now, listen carefully. 2.6% is lower than what Yuan Tai said earlier, 3 to 4% property loan, right? So please, if you don't mind, calculate together with me. Okay, no more GrabFood voucher, but just for fun, calculate. 2.6%, okay, just take out your calculator and calculate together with me, times $180,000, okay? $180,000. Okay, equals to 4680, correct? But this is annual. So divided by 12, $390. Okay, so basically, in order to have the $180,000 loan from OCBC, I will have to pay $390 per month in interest rate. Okay, good news again. Good news. Okay, So this particular thing is called an annuity. Just now I keep talking about leverage. Okay, now let's spend some time talking about annuity. So an annuity is something like a CPF. CPF is annuity, okay? A CPF Life is an annuity. So imagine annuity, they pay you every month. Okay, so the good news is every month you will receive an amount of money that is more than $390. So in other words, you don't have to pay the $390 out of pocket, right? It is from the annuity that you pay the $390. And with some extra. How much is the extra? Okay, here's where the table is very helpful. So you can see from the table that the extra is $4,200 per year. Not per month, per year. Okay, and how much money do you put in? You can see very clearly, 74,000. Okay, so obviously this is only suitable for people who look into their bank account right now and you can see $74,000 sitting there doing nothing, right? If you don't have the amount of money, you can completely ignore this third and final segment. So imagine you have $74,000, you don't know where to put. Should I put in fixed deposit? Should I top up CPF? Should I buy stocks? My answer, ladies and gentlemen, is to put into a leveraged annuity. Because you just need to put in one time, 74,000, and you enjoy a lifetime of monthly net passive income. Okay, so now this is based on 2.6% interest. Now the question, the obvious elephant in the room is, are you sure 2.6% interest will be there forever? The answer is not from my mouth. Okay, you have to do some research. Based on the interest rate cycle, okay, most of the years in the history of Singapore, the interest has been floating at around 2%. Right? This is taking the average of very high, 5 point something, to very low, 0 point something. Right? So the average is around 2 point something. So 2.6 sounds reasonable. But is this interest rate cycle enough? Not enough. Let's look at other things. Okay, so if you look at his history from 1982 onwards, then generally speaking, interest rate has been coming down, okay, steadily declining. Don't look at the past 12 months and say, no lah, siao ah, past 12 months increase. Past 12 months is called short term, okay? Look at long term. Since 1982, it has traditionally been decreasing. Okay, now look at the news. The Fed already announced, okay, that there are cuts coming in 2024, unless they are lying, okay, or unless they make a U-turn. But if they continue as planned, it is declining, right? So 2 point something% is realistic for the long term. Now, let's do a little bit of a. This part is the risky part. What if it is lower than 2.6%? If it's 1.5%, I got good news for all of you, right? Because the net passive income is going to be significantly higher than 2.6%, obviously, right? So in this case, you can see the simple average annual yield is 8.27%. Now, this particular slide, if you take a picture of it, please take note, this is the high risk part, right? Because none of the indicator is telling you that the interest will be 1.5%. But we're talking about long term here, right? If you continue to live for the next 20, 30, 40 years, who's to say that it won't be 1.5% one day, right? It is, then very good. That means you're enjoying quite a healthy return at 8.27%. If one day the interest drop to 0 point something again, like last time, then the simple average yield is going to be even double digit. Okay, so the average annual yield is fluctuating. Okay, on a more realistic level, let's look at the previous slide. On a more realistic level, the fluctuation is roughly around 5.62%. Not bad, right? Because 4.8% is inflation. So 5.62% net of interest, okay? This is already net of the interest you're paying the bank. It's not bad. It's quite healthy, 5.62. But if interest really drops in the future, then the net yield will be 8.27%. Okay, so as you can see, Victor was sharing something quite low risk. Yuan Tai was sharing something quite mid risk. And right now, I'm sharing something relatively higher risk because of the leveraged element, the loan interest. Okay, so take it only if you can stomach the risk. But if you can stomach the risk, I have good news for you. By year 15, you can take back the entire sum already. You put in only $72,000 to $24,000, and the entire $74,000 is returned back to you in year 15. So if you are someone as young as me, like 45 to 48, then 15 years later, just nice retirement, right? That means for the entire retirement years, every dollar you receive from this annuity is free money because the principal already returned to you. Also, every dollar that you receive is free money. Okay, so I don't want to spend too long talking about leverage annuity. I know it's quite a new concept to most of you. If you want to ask questions, please ask one-on-one, okay? Ask one-on-one. Now, this is the slide showing everything that Yuan Tai, Victor, and I have shared with you. I'm going to give you 3 seconds to quickly take a screenshot of this, right? And once you take a screenshot of this, don't just chuck it aside. If not, we waste all our effort, okay? Discuss with your spouse, discuss with your significant other, know which of these is your blind spot, right? Imagine if you're a soccer coach, right? Then you want to see, hey, who is the weak link here? Who is the weakest link? Is the midfielder the weakest link? Better replace that soccer player before you lose all your matches, right? Is the forward the weakest link? Is your defender the weakest link? The worst thing of all is the goalkeeper is the weakest link. Can you imagine? You score a lot of goal, but your goalkeeper keep letting in a lot of goal. You will never win. So please, we have a lot of information tonight, and for this, I really do deeply apologize. But please do your homework. Okay, right after tonight, sit down properly, look at your cash flow, and really monitor and assess or audit your entire portfolio to see which is your weakest link. And who agrees that after today you really need to do a lot of homework to assess your weakest link? Can you please put yes? Put yes. Or that means just by attending the webinar, it is not going to change your financial future, right? You really need to pick up the knowledge, right? Remember what you learned tonight, not tomorrow wake up immediately say, hey, last night, what did I do? Did I join a webinar? I can't remember. Okay, so you need to take out this slide again, circle all the things that are very weak. Like if you have never heard of leverage annuity, discuss with your spouse, hey, maybe, darling, maybe we should go into it. If you have never heard of zero tax rental and the Allianz Income Fund, discuss with your spouse that, hey, darling, shall we put some money on a dollar cost average, like what Yuan Tai said, right? Or you've never done anything like what Victor shared about legacy ATM that can pass to your children, then please seriously consider it. Okay. Well, I feel so generous that I'm going to give one more GrabFood voucher from my own pocket. Okay, what is the A word here? Fastest finger first. Those who already won the voucher cannot win anymore. What is the A word here? Knowledge alone is not going to change your financial future. What is the A word that will be critical to change? Dawn! Okay, Dawn will win a $10 GrabFood voucher. Dawn didn't win just now, right? First time, right? Okay, very good. Action. Also, what do you mean by action? Action means discussing with your spouse is action, looking at your cash flow is action, Zooming, Yuan Tai, Victor, or me, one-on-one is an action. Then after that, the actual action of putting money aside for that kind of strategy, that one will be later on, okay? That one, no rush yet, but at least take the action of assessing, auditing, analyzing, discussing with Yuan Tai, Victor, or me. Okay, this is my client. This is not the real picture because my client feels uncomfortable sharing his real family picture. Right, so this is Dennis Liu, and then he wants to create passive income using all the strategies we discussed tonight. So let's see how he does it. So first of all, he put CPF, which is about 2,000, where nowadays raised to 3,000, but because this is based on the past scheme, okay? Legacy ATM, 3,000. Zero tax rental can get roughly 5,000, and then leverage annuity he get another 2,000. So in total, he gets back about 12,000 passive income. I know some of us will say, why so greedy? Need 12,000 meh? Right? Trust me, because of inflation, right? Your $12,000 when you retire is worth roughly about $6,000 to $7,000 today. I repeat, if you are getting $12,000 per month passive income 20 years later, then actually it's only worth around $6,000 to $7,000 in real dollar value at today's value. Okay, so that's not a lot of money at all. That will just provide you slightly more than enough to go for your nice holidays and cruises. Okay, so now I'm going to share a QR code with you, right, at the count of 5 seconds, and then Yuan Tai will also share a link with you. Yeah, that's faster than 5 seconds. Okay, so 5, 4, 3, 2, 1. Yeah, please quickly click on the link or scan the QR code, and then what we'll do is we'll just contact you to schedule a 30 minutes to 45-minute Zoom. And I promise you something, okay? All three of you promise you something. There's no selling or product pushing for the 30 minutes to 45 minutes. If there is, you can screenshot us and then report to MOM or case or Mothership, or I don't know who you want to report to. Yeah, so it's purely educational. Why is it 101? I already said it earlier, because there's a lot of sensitive information. Okay, so in this link, right, please key in how much do you want per month when you retire. Okay, trust me, count in inflation, right? You need roughly about $8,000 to $12,000, right? Don't put things like 3,000, 4,000. You will feel very, very shortchanged and very stressed in your retirement years. Okay, so put a higher number rather than a lower number. And the second thing we need from you is your age, your current age, right? This is not Tinder. Please don't lie, Ken. Don't lie, huh? Right? If you're 45, put 45. If you're 48, put 48. Yeah, so using these two pieces of information, the monthly income you want and your age, then we will be able to calculate something like this for you. Okay, this Excel sheet you can take screenshot, but it's not relevant to you, right? This Excel sheet I created for one specific client, right? So if you want something like this where you know which year you get how much, then scan this QR code or click on the link. Okay. Now it's 9:37. We have the last 3 minutes. So please use these last 3 minutes to quickly key in your name, your age, and the monthly amount you want, and quickly type done, D-O-N-E, so that we know you are done. Right? If not, we just keep waiting and waiting, and we don't know who's done, who's not done. Okay, so quickly key in your name, your age, and the monthly passive income that you want, and then just type done. Okay, Sairam is done. And while you are typing, let me share the final thing with you, okay? I told you I'm 48. I got 3 children. Yeah, already 19, 16, and 14. And my wife hasn't worked a single day for the past 18 years now, ever since she was pregnant, okay? So life has been quite tough, to be honest. You know, I wasn't born in a rich family. And, you know, when I lost my job, it was very painful. But I just want to give you some encouragement, Ken? Because I know tonight, it's like, wow, very stressful. Oh, we need a lot of money. We haven't planned enough. Okay, I don't want to give too much fear to you. I just want to encourage you. Even for someone like me, right, I'm not finance trained. Right, my degree is in TV and film. You know, and I even lost my job. I even had to borrow money from brother. I had to restart life at the age of 39. Okay, so even someone like me, right, who look hopeless, so miserable, and then with such a large family, I tell you, the moment I made a decision to learn finance, to be disciplined, to spend less, and to save and invest more, my life changed. Okay, my passive income hasn't fully replaced my income yet, to be very honest with you. Okay, but it is closing the gap. Okay, every single year I'm closing the gap. So today I invite you to join me and Yuan Tai and Victor on this journey. Right, all of us hold hands together. Metaphorically, I'm not really going to touch your hand. Don't worry. Okay, all of us join hands together and journey together. Right, it's not going to be easy. Right, it requires a lot of discipline of setting money aside, but we're going to get there. And when we get there, I tell you, let's celebrate. Okay, let's have a good meal together and celebrate. A lot of people are going to suffer when they don't do this in the future, right? They still have to work when they're 67. Of course, if you enjoy your work, nothing wrong. Yeah, but some people will have to force themselves to work when they're 67, 68, 69, but you don't have to. You can pursue your interest. Maybe it's missionary, maybe it's volunteer work at a dog pound, maybe it is to help disabled children. I don't know what your passion is. Yeah, but once you settle the money issues, I promise you that you will find freedom to pursue your life mission and purpose. Okay, so I hope this encourages you. It's now 9:40. Okay, I just count down 10 seconds and we'll end this webinar. So if you haven't filled in yet, quickly use this last 10 seconds to click on the link and scan the QR code. But even if you don't like to fill form, don't worry. Tomorrow, Yuan Tai, Victor, and I will text you and ask you whether you want to have a Zoom session. So please don't ghost us, Ken. It's very we don't feel good when you ghost us, right? If you don't like, just say no thanks, right? Just no thanks. But if you like, say sure. Why don't we do it this weekend, next weekend? Okay. Before you leave, don't mind just share some encouraging things on the Zoom chat. Okay, don't just listen to a free webinar for 90 minutes and then leave like that. Okay, so share some encouraging things like what do you learn? What's the thing that struck you the most? What's the greatest, most important reminder? Or at the very least, thank us, or at least say, I love you, I care for you, or you look very handsome. You know, something lah, something, okay? Yeah, and then after that, y'all can go and spend time with your family tonight. Hey, thank you, Sifu. Thank you, James. So a lot of you, we owe the $10 GrabFood voucher. Don't forget, we want to keep our promise. Thank you, thank you. Thank you, Su Ying. Thank you, EP, Sairam. Wow, wonderful. Thank you, Sharon. Thank you, Joy. Wow, hey, your name, Joy, is really beautiful name.